you, John, for joining us here. This is your second TV interview that you've done, the first one being at last year's Delivering Alpha, so we are thrilled to hear your perspective, and specifically on M&A. And of course, there's so much deal news today to talk about. I first want to congratulate you on your 20th anniversary. Paulson Company this month celebrating its 20th anniversary in the business. You started off as an ARB shop, basically, so this is right up your wheelhouse.
That's right, and thank you, Melissa, and for CNBC for having me again here this year. That's right, this is a very exciting time to be involved in merger arbitrage. Last quarter, we had $1.1 trillion of announced transactions, and that's the highest it's been in the last 5 years and near the records achieved in 2007. What's driving the activity today is several factors. One is very low levels of interest rates. Two, a record stock market valuation, so companies can use either cash or stock to do transactions. And three, the transactions are accretive. So in a slow growth environment, by doing a strategic accretive transaction, corporations can grow faster than they can organically. And because of that, many of the acquirer stocks are being rewarded, and therefore the executives now are in a position, in order to grow faster, acquisitions are part of the mix. And if they don't grow, if they don't grow via acquisitions, they may themselves become a takeover target. So that's propelling activity, and I think that's going to continue for the foreseeable future.
And we're also seeing it in terms of how investors are playing some of these deals, including yourself. You're not only the holder of the targets, but also the acquirers. And so how has that changed since you first got into the business? Because that's sort of an unusual dynamic we have.
That's correct, Melissa. So we've been involved in merger arbitrage, as you said, for the last 20 years. So we built up a core expertise in this area. And we have people that are dedicated to this space. So generally, they worked for an investment bank in M&A before joining us. And as part of our research, we monitor just about every announced deal globally that's in excess of $1 billion. So our approach is there's, I would say, 5 key ways that we seek to profit in this area. One is by traditional merger arbitrage, which was capturing spreads. Earlier this year, they were rather tight, but they've opened up quite a bit. So in deals like Time Warner Comcast, they're trading around 8 to 10%. Covidien, Medtronic on the order of 14%. DTV, ATT around 10 to 12%. So that's attractive. The second area where you can do well is hostile takeovers. Hostiles is a different category. It's when an offer is made, but the outcome is uncertain, and the target will try and fight the offer. In those situations, you could lose money. They're risky, such as when Pfizer bid for AstraZeneca, then they dropped the bid. If you bought AstraZeneca, you would have lost. But they also can be very profitable, like what happened in Hillshire when Pinnacle initially bid 45, and it turned into a bidding war with Tyson bidding 50, then Pilgrim coming back at 55, and Tyson winning the bidding at 63. So in a matter of 3 weeks, the stock was up over 40%. After hostiles, another category is trying to anticipate which companies could be acquired next. And over the years, we've arbitraged thousands of transactions, so we see industries going through consolidation. And sometimes it becomes apparent who the next target could be. And if you can anticipate who the target could be prior to the acquisition, that could lead to premiums of 40, 50% and higher if that target is subsequently acquired. Now, the last category that's very important to us now is what you referred to as strategic acquirers. And there have been many very successful acquirers where they've bought companies and they've grown their earnings very rapidly, and the stock has appreciated tremendously. So probably the best example of that would be Valiant, which was a small company that Mike Pearson took over as CEO just about 4 or 5 years ago. And over that period, over the last 4 years, made 35 acquisitions. It's grown earnings per share by about 600%, and its stock is up 800%. So, so that's probably the poster child of a accretive acquirer. So we try and identify those acquirers that can deliver substantial value.
So you identify that acquirer, and you're on the Allergan side of the trade. What is your intent in terms of your holdings of Allergan, and how do you work out what the combined company could be worth? Because this calculation is actually very interesting, and I would imagine different from the dynamics that we had maybe a decade ago when managing the trade meant selling or leaving it once the deal's completed.
That's correct. And in many situations today, you can make far more than the spread by holding on to the acquirer's stock after the transaction is completed. Allergan and Valiant's a very interesting and perhaps controversial situation. This is a hostile bid where Valiant has made, I think, 3 offers now, a cash and stock offer to buy Allergan. The stock is trading somewhere around 40% higher than it traded at before the bid was announced. Now, as I mentioned, Valiant's a very serious acquirer. They're very successful, very well managed, and they take a different approach to managing pharmaceutical companies than your traditional pharma. So the CEO, Mike Paulson, is very cost conscious, and so generally when he acquires a company, he'll eliminate costs that he doesn't feel are necessary or duplicative with his existing operation. So if he is successful in acquiring Allergan, he will reduce costs to a point that it could be 25% accretive to Valiant's earnings per share. And since this is a stock and cash offer, if Valiant stock were to rise by as much as the accretion to Valiant's earnings, then Allergan could be worth as much as $2.20 per share. So instead of making the $6 spread, right, which is the value of the offer today compared to Allergan's stock price, if Valiant was successful and was able to achieve these cost synergies, instead of getting $1.72 per share, you can get as much as $2.22 per share.
$2.22, you said?
Well, that would be the price of Allergan. Mm-hmm. If Valiant stock appreciated by as much as the accretion in Valiant's earnings per share, and you took stock as part of the consideration for Allergan.
So you're holding. That's how you're managing the trade. You hold it. So you have confidence in Paulson, and that's a key part of the decision in terms of holding on the management of the company.
He's a proven success. He's done this over and over, very successfully, and I don't think anyone has created more value for shareholders in the recent past than Valiant has in the pharmaceutical sector.
Do you also have confidence in Bill Ackman? Because you built up your Allergan position after the May 31st filing, so it's a fairly recent position.
That's right. Well, this is another example of a hostile situation. So obviously Allergan has different objectives. They were a successful company in their own right and have their own culture, which would be disrupted by this transaction. But it's really at this point up to the shareholders, and Ackman is the largest shareholder, and he feels a lot of value could be created for Allergan shareholders by merging with Valiant.
Have you talked to Ackman? Do you guys talk and chat about this trade?
Well, he will have a call, I think, tomorrow. As part of the hostile, he will do a proxy fight to try and unseat the board in order to force the board to negotiate with Valiant. So, we will talk to him about the contest.
The CEO of Allergan in recent days, past week or so, has come out to the media talking about how he's open and looking for a deal actively. There had been speculation that Allergan would buy Shire, and interestingly, this is where your deal activity sort of merges or converges, I should say, because you're in AbbVie, which is obviously making a bid for Shire. How do you see this playing out? Is that
well? Actually, we're not in AbbVie, but we are in Shire.
Shire, sorry.
So we did identify Shire last year as a potential takeover target. They were a mid-sized a mid-cap pharma company growing fairly rapidly with an Irish domicile. So that made them very attractive for several potential U.S. pharmaceutical companies. So once Valeant made the bid for Allergan, then rumors surfaced that perhaps Allergan could be interested in acquiring Shire. And then last month it was revealed that AbbVie, which was a spinoff from Abbott, was about a $90 billion market cap pharma company, had made 3 bids in June for Shire that were rejected by Shire. But subsequently, this month, they've made a 4th and 5th bid that they're in negotiations to acquire Shire. So that ultimate price, believe it or not, is about a 90% premium to where Shire traded immediately prior to Valeant made its original bid for Allergan. Now, in the Allergan case, it's an issue that, it's possible they could succeed or defeat the Valeant bid, but standing alone is not a way they can do that. They have to do something else to create comparable or greater value than Valeant's offering. So one thing they could do is an acquisition of someone else. And what's interesting, last year, Valeant had made a bid for Actavis.
Which you also hold.
Well, we hold it now. We didn't hold it at the time. But they bid $100 a share, and then I think bumped it to $110 a share. And Actavis didn't want to sell, and instead of selling, they bought Warner Chilcott. And they achieved so many synergies as part of that transaction that their stock now trades for $210 a share. So they were able to increase the stock market value 100% more than Valeant offered last year by going out and doing a strategic, accretive transaction themselves. So that sort of creates a path. One way that Allergan could repel the Valeant bid is by creating more shareholder value through a transaction.
So basically in Allergan, the way you look at the trade is, I don't want to say there's no downside, but there's upside in that if they're bought by Valeant, then there's a premium. They're worth $222 a share roughly. If they're not, and they enter another deal, they'll create shareholder value through another acquisition in which they will be the acquirer.
And thirdly, they could do some of the cost rationalization that Valeant's proposing themselves. So if they could reduce their R&D budget and reduce their SG&A, they can grow earnings faster than what the street anticipates, and perhaps to deliver comparable value by doing some of the actions that Valeant was going to do by themselves.
So there's 3 scenarios in which you make money on Allergan, and the last scenario, which is do nothing, is
now in a hostile. It's always risky that the bidder drops the bid and the stock falls. So in the case of Pfizer's bid for AstraZeneca, they made the bid, AstraZeneca went up, and then they dropped the bid. So Pfizer was not willing to do a proxy fight, and they were not willing to take the offer directly to AstraZeneca shareholders. So it was kind of, from a hostile perspective, a rather weak bid. Valeant's bid is different. Number one, they are taking the offer directly to shareholders, so shareholders have a chance to choose. And 2, they have a very aggressive shareholder in Bill Ackman, who's willing, if the board refuses to negotiate, start a proxy fight to unseat the board. So at that point, standing still does not seem an option. So I would say the high probability is there's 3 ways. 1, Allergan succeeds. Valeant succeeds. 2, Allergan buys someone. Or 3, they do some internal restructuring that creates additional value.
So in terms of scenario number 2, in which Allergan would be the acquirer, can you see Allergan making a viable bid for Shire, considering that AbbVie and Shire have basically until Friday to respond under UK laws?
Well, I know as much as anyone does from the public information, but it seems right now...
But you're not just an ordinary member of the public, John.
Well, it seems right now AbbVie and Shire are getting close to a deal. If Allergan may have had an opportunity to participate, they don't seem to be participating in this particular transaction.
even though Shire, AbbVie, that's purely, it looks at least, and I think the CEOs would acknowledge that that's purely based on inversion because the overlap in their portfolios is virtually nil.
Well, there's a couple of strategic reasons for the transaction. So one is the tax inversion issue. Two, there is some overlap in certain key areas. But three, I think the most important issue is that AbbVie is doing extraordinarily well. But a lot of their success is based on one product, which happens to be Humira, which is the most successful or largest pharmaceutical product out there, which is growing very rapidly. But because of their over-reliance on that product, the company trades at I would say, a below-market multiple. So by acquiring Shire and broadening the base, it's likely that the combined company will trade at a higher multiple than AbbVie traded at before because of the benefits of diversification and a broader growth platform that they could add additional, more value than they could achieve by themselves. So I'd say there's three reasons why AbbVie is so intent on doing this transaction.
And that's the deal that you would like to see happen. I mean, when you see the four players, Valeant, Allergan, Shire, and AbbVie, you see the combinations that are basically have already been priced into the market.
Yep.
AbbVie, Shire, and then Valeant, Allergan. That's the way you see it play out?
I think in this case, AbbVie is likely to succeed with Shire. We'll know by Friday because that's the what they call the put up or shut up date.
Right. And how do you manage that trade? Do you hold on through the integration?
Well, that's interesting. We'll have to see how accretive this transition is to AbbVie. I think based on the numbers we've seen, it will be accretive to AbbVie's earnings per share. So their earnings per share will go up. If they also get multiple expansion, then AbbVie stock could rise after the transaction. And if you hold on to your Shire stock, you can get an additional premium.
So that's sort of an unknown as of now in terms of whether or not you hold on. Whereas in Allergan's case, you are intent on holding because you see the value post-deal.
That's right.
Okay. Let's talk about another area where you see a lot of activity brewing, and that is energy. And there was a headline Monday morning, Whiting Petroleum, Kodiak Oil and Gas. You're on both sides of those trades. On paper, you made roughly $360 million.
Yeah.
Was this a case where you saw two players that were ripe for a deal, either as targets or acquirers?
Yeah, that's correct. What's going on in the oil sector in the U.S. is just amazing. That U.S. is leading in the oil extraction technology that no other country in the world comes anywhere close. So as a country, we had vast reserves of oil in shale, but it's attached to rock. And until recently, they didn't have the technology to separate and extract the oil from the shale economically. But really, in the last 5 years, they've perfected that by both horizontal drilling and fracking, that they can now extract this oil very economically. And one of the most prolific areas where they're accomplishing this is called the Bacon fields in North Dakota. North Dakota has now grown to be the second largest producing state in the country after Texas. So within the Bacon, you have five majors, including Exxon, Statoil, Hess, and you have three leading independents. And those three leading independents were Whiting, Oasis, and Kodiak. Then you have a large independent called Continental that's controlled by a large shareholder. So each of these three companies were growing very rapidly. They're growing production last quarter between 25 and 50% year over year in an environment where the majors have declining production.
I just want to, just as a footnote to the audience, you also have a position in Oasis, about a 9.8% stake.
So we became now, in addition to growing very rapidly, they have huge reserves. Between the reserves and resources, they can continue producing oil at current levels for about 50 years. And they're trading at very modest multiples of EBITDA. In some cases, less than the multiples the majors are trading at. So to us, it looked like they were all potential, each of these three potential takeover targets. At the same time, if they weren't taken over, the stock should appreciate because of their rapid growth. So we became the largest shareholder in each of these three companies. And what happened on Monday was Whiting announced an acquisition of Kodiak, and that's very accretive to Whiting, and as a result, both Whiting shares and Kodiak shares have appreciated.
Do you hold on to this? And I ask this because does this acquisition take a Whiting Kodiak combination out of the game in terms of further acquisitions, whether the combined company becomes the target or the acquirer?
It's a very exciting situation. One thing about the oil sector, it's a very large sector. So before Whiting bought Kodiak, the company with the second largest acreage in the Bacon of North Dakota was Exxon. So Exxon's there, Statoil's there, there's other majors around. The combined company now will have a market value of about $17 billion. But when you look around the world, Exxon has a market value of $440 billion. So while Whiting is bigger, in a sense it becomes more attractive to other large oil companies that don't have a presence in the U.S. And the remarkable thing about the U.S. is that there's no restrictions on private companies buying oil assets. Along with Canada, it's, I think, the only country in the world where the oil sector is private. So, and if you're a major oil company and you don't have a presence in the remarkable revolution that's occurring here, you're sort of left out. So, ultimately, I think the combined company, as well as the other independents, are still attractive to other larger acquirers.
The stock reactions were interesting to watch on Tuesday because Oasis fell. And so what that told me, just as a market observer, was that because there was some overlap between Kodiak and Oasis in terms of the presence in the Williston Basin, that perhaps it was thought that Oasis was no longer a potential takeout target by Whiting, and so it was left on the side. It was down 5%. What happens in your view to Oasis at this point?
Again, these companies are outstanding companies. They're run by entrepreneurs. They're innovators in the energy sector. Oasis is growing very rapidly, has very attractive acreage, so I think the upside, either as an independent or a target, are very good for now the combined Whiting and Kodiak as well as Oasis.
Could they all combine? I mean, Whiting, Kodiak, and Oasis?
There's many possibilities.
Let's just say in a year, do you think that the combined company, Whiting, Kodiak, and Oasis, do you think they remain the same in a year, or do they have a different, do they belong to somebody, or have they acquired somebody?
These companies are just too attractive. They're too attractive to sit there at the current valuation. They're independent, they're in the U.S., they're growing very rapidly, they have enormous reserves, and the cost of harvesting the reserves continues to decline every year. So it's just, it's not likely they may remain as independents for a long period of time.
They may remain in it, so
it's not likely they will remain independent for a long period of time.
Okay. Let's switch gears and talk about a deal that we saw this morning, because you're also very interested in media. Yep. And so we all open our papers, including yourself this morning, to a 20th Century Fox bid for Time Warner. Massive bid, $80 billion, which has already been rebuffed. But how do you take a look at that deal? What's your thought process in determining whether or not that is a deal you should be participating in?
Good question, and that's exactly what we had to focus on this morning. So the key issue in a hostile is, what are the probabilities that the transaction will be completed either with the bidder or another acquirer? And then how high could the bidding ultimately go for this particular asset? In this case, the first thing, one way to estimate that is to look at the size of the acquirer relative to the target. So generally, the bigger the target relative to the bigger the acquirer to the target, the greater the ability for the acquirer to pay a high price. In this case, they're about the same size. So there's a limit to how much a Fox could ultimately pay for Time Warner. So we're not going to see a very rapid type of bidding we saw in Shire, where the premium ultimately was 90% above the unaffected price, or in Hillshire, We had two very large bidders bidding for a small asset that was both very strategic to them, where the ultimate price was also around 80 to 90% higher than where Hillshire traded initially. When you're the same size, there's a limit to how much cash you can pay, and there's also a limit to how much stock you could provide before it becomes dilutive to the acquirer's stock and the stock goes down. The second thing we look at, are there other bidders that could potentially surface? And at this size range, there's not a lot of other potential acquirers. Third, you have to look at, are there any antitrust issues? So we already did a preliminary analysis of that, and surprisingly, given the size, there doesn't appear to be any major antitrust issues. I think Murdoch identified the asset that would be most troubling, which would be CNN, which he agreed to sell up front. So the question is, does Murdoch come back with another bid, and could he ultimately persuade the Time Warner board to sell, and how high could he ultimately go? So these are all the issues that we have to look at.
It sounds like you're still looking at it. This is
We're
still of
looking
interest
at it. Yeah,
to you.
it's still of interest.
Why would it be of interest, and what side of the deal would be most interesting at this point?
Well, the issue is, if you buy Time Warner stock today at 83, is Murdoch coming back, and how high could he pay for Time Warner and still make sense for Fox shareholders? And then if he doesn't come back, the stock is up $12 today, could potentially fall. So I would say, it's a large deal, it's exciting, but because of the dynamics, it's not a slam dunk as to what the outcome could be.
Right.
And I should stress that any hostile deal is going to be risky. So in the case of, again, going back to AstraZeneca, Pfizer, if you bought the AstraZeneca stock after Pfizer made the bid, would have been a losing transaction. They ultimately did not make a hostile tender offer, did not make a proxy, and the board was able to just say no, and Pfizer went away. So you have to always approach it from a portfolio perspective with the understanding you could be right, but you could also be wrong.
Well, at this point, John, do you think that you would be more right or more wrong if you, what is the bottom line here? You're still looking at this, and so this could potentially be of interest to you? Or does it look so unlikely, or the risk reward
Well, let me
is just
say,
not there
from a
at this
shareholder
point?
perspective, it looks like it continue, but it's not all that exciting. It's not going to be like a Hillshire, where the ultimate bidding could be 40% higher than where the first bidder came in and 80% above the transaction price. Here you've got an evenly priced, evenly matched acquiring target, limited flexibility how high the acquirer can go, and a very recalcitrant board in Time Warner that they don't appear to want to sell, and a difficulty in Fox in ultimately making a hostile offer directly for Time Warner shareholders. So it's not, from a shareholder perspective, getting involved at this point, it could work out, but it's not all that exciting.
And in our chat last week, you had indicated that for media deals specifically, it's not as attractive. The accretion isn't necessarily there after the deal, so these are more opportunistic participations on your part.
There is some accretion. I think they identified about $1 billion in accretion as a result of the merger, but the higher the value goes, the less the accretion for Fox earnings per share. So it won't have the same type of impact that Valiant's bid for Allergan has, or that Abbey's for Shire has, or some of the other deals that we're involved in.
We're just about out of time, unfortunately, but I did want to circle back to some advice that you gave last year here at Delivering Alpha, and that was to the average retail investor. And essentially you said that the best investment one could make would be to buy a primary residence. Do you still stand by that? And how about all those institutions who went in and bought single-family homes and are renting it for? Is that a bad investment?
I still think, from an individual perspective, the best single investment you can make is to buy a primary residence that you're the owner-occupier of. Today, financing costs are extraordinarily low, so you can get a 30-year mortgage somewhere around 4.5%. And if you put down, let's say, 10%, and the house is up 5%, which is the latest data, then you'd be up 50% on your investment. and you've locked in the cost over the next 30 years. And today, the cost of owning is somewhat less than the cost of renting. And if you rent, the rent goes up every year, but if you buy a 30-year mortgage, the cost is fixed. So I think it still is a very attractive investment.
If you were the owner-occupier.
If an owner-occupier.
And as a secondary to rent, that's not a good idea.
Yeah, to buy it as an investment and rent it out I'm not so enamored with that concept.
All right. John, thank you so much for joining us. We really appreciate it. Ladies and gentlemen, John Paulson.
Thank you, Melissa.